Welcome to the Private Lender Podcast with your hosts from Hard Money Bankers, Jason Balin and Chris Haddon. This podcast is sponsored by hardmoneymastermind.com.
Hey everyone, thanks for checking out the podcast. Chris and Jason here, Private Lenders Podcast, sponsored by Hard Money Mastermind, innercircle.com. If you are interested, we probably have one spot left for another lender for our meetup, our 2-day full-on Inner Circle meeting in Nashville, early November. If you are interested, we've been on a wait list. We could probably take another group. Check it out, Hard Money Mastermind, innercircle.com. Okay, today we're talking about the scripting that we use to get larger down payments from borrowers and being able to charge higher rates and points. Jason pretty much wrote the book on this one. He is going to dive into it. For years, he's been using this, teaching it to our business partners and also members of the mastermind and Inner Circle. I'm going to throw one little part at the beginning that we're not really going to cover today. But what makes this all possible, all of this scripting and making it work, is lead flow. This is not a marketing podcast. That's not our topic for today, but it makes life so much easier to be able to quote how you want when you know that you have another like 3, 4, 5, or 10 leads coming in that day, right? So again, we're not diving into marketing on this one. We cover that in many other episodes, and I'm sure we will again many times into the future. But today we're talking about Jason's playbook for how to quote loans, the scripting to quote loans to get the down payments you want and to charge the fees you want.
Well, it's such a popular topic, and I don't think we realized it. Obviously it came up with a lot of our partners in other markets, but it came up even more as have gotten closer to the mastermind group, and we've talked to a lot of our consulting clients and other members of the mastermind of, hey, like, I want my borrowers to put up as much money into the deals as you guys do, and I want to charge higher rates, but like I can't, or I don't think I can. It's more like I can't. Like, those aren't the deals that I get. I don't get the same deals that you get. It's like we all get the same deals. And going back to what you said, yes, you do need to market so you can get lots and lots of looks. You can't look at one deal a day, right? Or do whatever. Or another rebut is, well, I've been working with the same borrowers over and over. They're expecting 100% financing, right? And that's fine. And that's fine. You want to continue to do that, that's fine. But I think a lot of people are tuned into this podcast, and a lot of folks are, interested in learning more about proper private lending and hard money lending, because the market could be changing. Things change. They realize that if you're lending at 100%, you have a lot of exposure and a lot of risk. And one borrower disappears, or a project goes sideways, or the market shifts, and you're losing your own money, you're losing investor capital, and that can't happen. The purpose of this business is to write safe, secure deals with a good, solid rate of return for yourself and for your capital investors. So you can't lose money. That's 101. You cannot lose money on this, and you're going to if you don't write proper loans. And it's not an exaggeration when we say that at the very, very, very minimum, no matter how good a borrower's deal is, they're bringing at least 20% to the table plus closing costs. So in our markets, because we have high transferred recordation fees and property taxes and insurance, that it's like 7 or 8% in closing costs. So they're bringing close to 30% minimal. That's what somebody with 700 credit score and with experience in buying a good deal, they're bringing darn near close to 30%. A lot of the deals, the borrowers are bringing more. And that's just what it's, how it's set up. And, we'll talk about larger down payments first, then we'll talk about interest rates second. But, everything we do is the same. And, sometimes it's actually better when you can't negotiate. This is our set terms. This is our set parameters. That's just what it is for everybody across the board. So you don't second guess yourself. When you say, hey, I'm going to do a loan, I can do a loan for you for $200,000. Your cash to close is going to be like 70 grand. And they come back and be like, hey, I really want to be at 50 grand. And then you don't say, oh, I'll meet you in the middle at 60 grand. Right. Like, this is how it's set up, right? Like there's very little negotiation that's done, which is could make your life a little bit better, a little bit easier, could make salespeople's jobs a little bit easier. If you have some, by just saying, this is the best that we can do on the particular deal. And in a second, we'll go around how to sell against other companies that potentially are offering more favorable terms than you are. But the point is like on one side, I think everybody realizes the importance of high down payments and making sure the borrower has real skin in the game, real cash into the deal, and that your exposure is low, right? That's the first part of it. And the second part is just being consistent to yourself of, I understand the importance of this. I don't want to cut corners. I want to do this the right way. And you do it. And keep in mind, a lot of deals you're going to have to say no to, or a lot of deals are not going to work. And that's just the nature of it. And you got to kind of get over that. You got to put that in your head immediately that you're not going to win every deal. Take your ego aside that you're not going to win every deal. And that's okay. And yeah, does it kill me sometimes where like there's a really good borrower, maybe a borrower that I've done dozens of loans for in the past, and they're like, Jason, come on, man. We've known you a long time. Work with me on this deal. I don't have as much cash as I had in the past. And it's like, listen, man, I'd love to help you, but this is what I'm comfortable with. This is what I'm comfortable with. We lend our own money on these deals. We're not Bank of America. I understand that you put out a good product and you're good for it, but this is all we're comfortable lending on this particular deal. And if you want to explain in detail the reasons why, you can, but we kind of keep it simple. And this is how we do it. And I think you'll be surprised. You'll win, even if somebody's not immediately happy with you up front. I think they typically, if you're kind of firm about it and you're consistent about it and you explain to them the down payment requirements, they respect it. And if they can make it work, they can make it work. And if they can't, they can't. And a lot of times they can, right? If you're off by like, a big percentage, meaning like they need 50 grand cash to close and they only have 20, I mean, there's nothing you can do on that, right? Like it wasn't meant to be to begin with. But most borrowers and most clients, if they want to bring 40 to the table and you're telling them they need 50, chances are they'll make it work. And you can use some selling scripting and related to, hey, listen, I'm a private lender. I'm local. I've been doing this for a long time. I know deals. If you have any issues, you can come to me directly. If I tell you we're going to close on this date, we're going to close on this date and fund on this date. All of our construction draws are done in-house. If we typically our draws can be done in 1 or 2 business days. We move very quickly. If you have any issues, you come to me directly. Sell what the attributes that you have, right? Like, if they go through a bank or an institutional back lender, that it's going to be a clunky process. It's going to take a long time. The draws do not happen overnight, and they're going to be lucky if they even close on those deals. If you're a private lender, I tell people, it's like, hey, listen, man, we're a private lender. I want to help you. I want to make this work. I might not be as cheap as your bank or your institutional back lender. I might not give as much leverage, but I'm going to make this really easy for you, right? The average deal that we close typically closes in a week, right? Because we need to move quick, right? And we can do so. If you don't have full available capital to fund deals that quick, that's okay. You don't need to close that quick if you don't have the ability to. But the point being is sell what you have, right? Sell the attributes you have. Local, quick, flexible. You can come to my office and meet me. Whatever it is. What am I missing on that, Chris?
No, so I want to jump in on a couple things because I just want to highlight a few things that you said that I think that people listening or watching today can use today to help in these conversations. So there's a number of things that Jason threw in there related to his go-to scripting. And I think one that can help people immediately is what he said about, look, this is just where we're comfortable on this deal. And that's not to say anything about you or your project. You'll probably do great on this. But we're not Bank of America. We lend our own funds. We just have to be careful, and I'm not 100% sure, current value as it, like, not exactly sure. This is just where we're comfortable. And people respect that. You're not insulting them. You're not saying, oh, we go by strict guidelines and it appraised for 375. Therefore, we have to do exactly this loan amount. That's not the way it works. And something else Jason threw in there is like, he always says up to 80% of the purchase price, 100% of construction costs, up to potentially 65% of the after repair value. And that gives you that wiggle room that you need to quote how you want. And yeah, I know Jason said average of 30% between the 20% down payment and 10%-ish, 8 to 10% for closing costs. But when I'm looking at deals in the pipeline, acquisition and rehab deals, as I'm going through in my day-to-day looking to see what funds I'm putting into which deals, it's oftentimes more than that. It's like across our other business partners too in other markets, it's oftentimes more than that because they're using the scripting, because we know we have other deals coming behind it. And here, this is just kind of a random tidbit that I'm going to throw in. One way to tell immediately by a lender's marketing that they are institutional backed and not a real private lender? There's a lot of answers to this, but do you know the answer if I say one way to know from their marketing right away they're institutional backed?
Were you asking me a question? Yeah,
Yeah.
based on their loan amount. If it's like 142,750, they're using
exactly.
Mhm.
And I see it every day on social media, LinkedIn, emails. If your loan amount is $201,750, that's some dumb bank shit right there. Make it 200K. What's the matter with you?
Mhm.
200,000 is a loan amount. Why use these like odd numbers when you can use round numbers, which everyone likes? The reason being is because they're going exactly 65 or 70% of where that after repair value appraisal came in.
As long as you're rounding down, not up, down.
Yeah, down, or even if you want up because you're given the right loan amount anyway. Maybe it's 205.
Yeah.
Like, you know what I mean? But like 201,750, it's like, come on, dude. Like, you think anybody thinks that you're lending your own money? No.
Exactly.
Anyway, that's a little bit off the point. But in terms of quoting loan amounts and wiggle room and scripting, it is valid, and just saying people, and also like we had a call with a new Inner Circle member this morning, and you were using some scripting that I think is going to be helpful. Maybe you can touch on for people related to areas that you might not want to lend in or might not feel super comfortable lending in.
Well, I think the point is a lot of folks don't, they obviously we all want to help clients and borrowers, and I get that. And we all do want to do deals, right? We're not trying to figure out ways to just kill deals, but you got to be safe on them. But at the same time, people are nervous of like, well, I don't want them to cut me off and never give me a deal again, and I'll have a bad rap around town and things like that. I don't want to turn them down, or I don't know how to turn them down. I've turned down tens of thousands, maybe 100,000 of people in the last 16 years. And there's very few that have ever been upset with me because you do it the right way and you do it with class. And then you don't tell people their deal sucks or it's not in a good area or their credit sucks. And that's why you do it. You base the conversation on what you're comfortable on what you're going to be comfortable with telling them. So like, I'll give you an example. We let, our core markets, obviously the Washington, D.C. area, the Baltimore area, the Philadelphia area, some other areas. And Baltimore has some not the best neighborhoods. And, Baltimore County is good. Baltimore City, not the best areas, right? And we probably only lend in like 10% of that particular city. We get a lot of deal flow. It's a populated area. We get a lot of deal flow there. I'm typically turning people down. A few different ways to do it. But one way that always works is like, hey, man, this seems like a great project. That being said, honestly, like I just don't know that area that well. And we lend our own money and our investors' capital. And unfortunately, I'm just not comfortable lending in that particular neighborhood just because I don't know it. And sometimes initially, they'll be like, oh, I mean, why? Like, what's wrong with it? And I'm like, it's just not an area that we know. I know a lot of investors that made a lot of money buying rentals and buying flips in that area. It's just not something that we're comfortable with. We just don't know, right? Now, I could have been like, hey, you're buying a property in a crappy area or you don't have enough cash. I'm turning them down the nicest way possible and being respectful, doing the same thing, right? Like I know other lenders will be like, oh, that deal sucks or your credit's crap, right? That might be the case on this deal, but I'm doing it the right way. That when they have another deal around, they'll reach out to us. And I think that's important kind of across the board. You don't have to, whatever, give them daggers for no particular reason. So, and here's another thing that I think comes up. I'm glad you brought this. We turned the conversation to this, Chris, is you don't have to stick to 65% or 70% of the after repair value on every deal. You do it based on the way you want. We will lend up to 65% of the after repair value, up to 80% of purchase, 100% of construction. Now you heard me say, and what Chris said earlier, up to. And that's like if they have great credit, experience, a lot of liquidity, things like that, right? We can structure it however we want. And we'll go over some rebuts if someone busts our chops on that as well. But that's like best case scenario. Let's say we're just not all that comfortable with that particular area or the borrower or the particular deal as a whole. Be like, hey, honestly, like, I don't really like this project. This is why. Maybe it's the area type of thing. Or unfortunately, like, typically, we try to have our clients have 680 plus credit scores. Yours is a little bit lower. That's okay. We can still do it. But, we'll be able to lend 100 grand on this project if you can bring 70 grand to the table, something like that. Right. You do it the right way. Nobody's going to be upset about it. You explain to them the reason why, and it's fine. So I don't know. I feel like I don't know if that kind of naturally is what we just do. Like, it just kind of naturally happens. That's how we do it. But I think if you script, when you're doing scripting and you're communicating with people, as long as you're genuine, and I think doing it over the phone is a good way to do it. If I send them an email and say, we can lend 100 grand, you need 70 grand cash to close, take it or leave it, like, they'll be pissed off. Like, it doesn't come out the right way. But if
this only works on the phone.
But if you present it genuinely, like, it works. And this is the same thing with interest rates. If someone's like, oh, I need a lower interest rate, and
that's gonna be my next question, is some rebuttals related to pricing.
Yeah. So, I mean, pricing's different now compared to October 2022 and before, when there was cheap institutional capital and things like that. Mm-hmm. I mean, a 12.99 interest rates, there's not many rebuts this day and age. But again, it's a similar process. It's like, hey, we lend at 12.99 and 3 points. And if someone's like, oh man, who the hell is going to pay that? Right. It's like, I gotcha. It might not work for everybody. That's being said, that's how we structure our loans. And that's what we're comfortable with. If you can make that work, happy to help you out. Just so you know, the way that it breaks down is your monthly payment would be $1,083 for every $100,000 you borrow. Right. So how long do you need to close? How long do you need to, the capital out for? Like, how long do you plan to flip this property? They're like, I don't know, I'll get in and out of this thing quick. It's like, okay, well, it's going to end up costing you about $10,000 for every $100,000 you borrow for 6 months, right? Between the interest rate and the points. So, if you can flip it even quicker, it ends up being even cheaper. So, that being said, we'll give you $100,000. It's going to cost you $10,000. That's what it ends up being if you do the math at 12.99% and 3 points over a 6 month time period. So if you explain that to them, sometimes all of a sudden it's like, oh, 12.99 is not like a credit card payment, because that's what a lot of folks equate to. Well, this day and age is probably a lot higher than that, a credit card payment. But regardless, you got to rebut it a nice, genuine way that makes sense, and explain it to them. And I think that goes a long way. So, I mean, I'll tell you that we don't have all that much trouble, scripting and communicating this type of stuff. And it takes time to learn it, and you need reps. And going back to like the first part of this podcast of, you need deals, like you need leads, you need reps. Honestly, like, I don't think the position of originating business at the beginning should be outsourced. I think you should do it yourself, and learn kind of how to do it the right way, and communicate and look at lots of deals, because too many folks aren't looking at enough deals. Their down payments aren't high enough. Their rates aren't high enough. They're wasting a lot of time trying to structure a deal that potentially probably isn't that good of a deal. And on the back end, it ends up not being a great deal. And there's nothing good comes out of that.
Yeah, to highlight some of those points for everyone listening, it should not be that price sensitive now. Based on where rates are, where the competition is quoting, you shouldn't be afraid to quote the rate and points that you want. Even if that means, now this is a judgment call for you, like, and we do it too. Like, there's a few people out there who they bring a higher loan amount, so that's part of it. And they've gotten some cheaper terms from us. And for those few or handful of people out there, I understand that it's hard to go back on what you were quoting, them on their last deal or last two deals. You can do it if you want. And it's a little bit of a gamble. You'll probably still get the deal. I understand if people don't want to, but for new people, definitely don't be afraid to quote the price that you want. There aren't that many real lenders out there right now with real capital who can close in a week and execute on their deal. There aren't. And when people initially say, no, I'm going to shop it around, or let me see what I can find, many of them come back. 70, 80% of them come back and end up closing. So that's on the pricing side of things, something to be very aware of. And, have confidence when you quote. If you have real money to lend, that is something that people in the real estate community need. So you should be confident about the loan amounts you quote, the price you quote. Also, something else real quick, just before we wrap up, related to down payments. So I was emailing with one of our capital investors who's normally a pretty passive guy. He's a very savvy investor. He's just a busy company owner who makes a lot of money, has a good amount with us. And we were looking at his portfolio over the weekend. And again, this is, Saturday and Sunday. It's just by email. And I was noticing that out of like 12 or so loans, he has 3 or 4 in default that are like really in arrears. And they're fine defaults. They're going to pay in full. We're based on our loan amount, our leverage, we're in a very good position. And our default rate is 24%. We're going to pay investors 17 and keep 7. It's about a 70-30 split when in default. And I just let him know that based on his current portfolio, the reason why some of his interest year to date is lagging behind is that he has a few defaults. And this guy's been with us for a decade or more. He's not worried or anything. But the reason why I finished with this is because loans go into default even when you don't expect them. Even when you sign off on the borrower, you sign off on the loan amount, everything seems together, their exit strategy, they'll still go into default sometimes. They just do. Ones that you don't expect to go into default, just so happens this guy has 3 or 4 at one time. It's all going to be fine. But what makes it all fine is the loan amounts that we quoted. If we were over leveraged on these loans, I would be a little nervous. He would be nervous, and we'd have to scrape out somehow, maybe not even with a full payoff. So just keep that in mind related to your quoting. If you don't have defaults yet, it's going to happen eventually, just statistically, right? And so you have to be in a position to not only be safe with your principal, but get that extra return for you and your investors in a default scenario. So I hope you guys learned from that. I hope you guys learned some stuff that you can implement today on these next phone calls you get today and for the rest of the week when you're looking at new deals. Also, like I started with, if anyone is interested, our next Inner Circle meeting is in Nashville, early November. Check it out, Hard Money Mastermind, innercircle.com. And we'll see you next time on the Private Lenders Podcast.
We hope you enjoyed this episode of the Private Lenders Podcast. Please note that the opinions stated by all the speakers on this show are only opinions and not intended for legal, financial, or accounting advice. Please make sure to always check with your own legal, accounting, and financial professionals. If you enjoyed this episode of the Private Lenders Podcast, we'd appreciate it if you would spread the word. Make sure to check out hardmoneymastermind.com, the #1 free community for new and experienced private and hard money lenders.